Charles Schwab was just downgraded because of how fast clients are pulling their money out of their accounts. Earlier today, Morgan Stanley analysts put out a statement saying that they're downgrading their outlooks on Charles Schwab because, let me read you the line, Charles Schwab clients are pulling cash out of the firm's low interest bank accounts at twice the rate that Morgan Stanley expected. So Morgan Stanley is an investment institution. They're looking at Charles Schwab as a potential investment, and what they're saying now is that they don't expect the Charles Schwab stock to go as high as they thought because of how fast people are pulling their money out. The reason why this is significant is because Charles Schwab is losing some of the ability to have access to cheap money, right? Because when you put your cash into a savings account in the bank, well, the bank gets to use that money. They get to lend it out, they get to invest that money, and they have to pay you just a low rate of return, that interest that you get. And so Charles Schwab had the ability to borrow and spend the money that people deposited into their Charles Schwab's accounts. But now what they're seeing is that people are pulling the money out their low interest Charles Schwab accounts very quickly. They're saying that about $20 billion a month have been being pulled out of the low interest accounts at Charles Schwab. Now, I do want to clarify one thing about this downgrade, because from what I saw on the internet today, there's been a lot of confusion about what this downgrade means, because today Morgan Stanley downgraded their outlook for Charles Schwab. Last week it was Citi and also JP Morgan Chase Bank. They all three of these investment institutions, banks, downgraded their outlook on Charles Schwab. But these are not credit rating agencies. The credit rating agencies are your Moody's, your Standard & Poor's, and your Fitch. These are your three credit rating agencies, the main ones, and these are the ones that are rating the health of a company. And when you get a downgrade from one of these credit rating agencies, that is like a very, very, very bad sign. When you get a downgrade from, say, Morgan Stanley or JP Morgan, that's not a good sign. But what that means is essentially they believe that your company isn't worth as much as what it's trading for. So it's a little bit of a different meaning, and I want to make sure you understand that before people go and really panic about what this means, because I really want to explain that first part. But Charles Schwab has spoken about this, and they said that they are still doing okay financially, that they still have a lot of liquid reserves. But it's something that you want to pay attention to because Charles Schwab is a major investment institution. So there's a few things that I want to highlight. First, what is the implication of this? Why is this happening? And what happens if you see a major institution like, let's just say Charles Schwab, where a lot of people are investing their money? Well, what happened if something like Charles Schwab did fail? Because we are seeing a lot of craziness in the banking sector, and interest rates are still rising. All these things are going to have impacts. Well, for one, for Charles Schwab, this downgrade really just affects investors and people's perceptions. Because when you see a downgrade of a stock, that means that you have these investment institutions like Morgan Stanley, JP Morgan, Citi saying that they don't think that the stock is worth as much. So in general, theoretically, that would mean for other investors, maybe it's not as good of an investment, which would pull the stock price down. But what we're seeing happen today is that this downgrade of the stock price is also influencing some depositors and investors who keep their money in Schwab, saying, "Ooh, this might not be a good sign for this bank or this investment institution. Maybe I should move my money somewhere else," because of just the environment that we're in right now. People are very worried about the health of the economy, the health of their bank, the health of their investment institution. And so people have been moving their money. And that's why we've been seeing a lot of regional banks lose money, because people are pulling their money out of regional banks and they're moving their money into a place that is hopefully, according to them, too big to fail. Because if they put their money into a big bank, then if that bank were to fail, then people would feel confident that the government would come in and bail them out. Because we have a lot of interesting circumstances right now, like when Silicon Valley Bank failed. We saw the FDIC limit, which is typically $250,000, go up to essentially infinity, where the Treasury Secretary and the Federal Reserve Bank worked together to essentially create a unlimited FDIC insurance. But then, not too long after that, Janet Yellen testified in front of Congress and said that she cannot guarantee unlimited FDIC insurance to everyone. She said that essentially they will only provide that unlimited FDIC insurance if a bank failure would cause wider economic concern. AKA, if the bank is small and it doesn't cause major pandemonium, then there's no reason to really bail out the depositors. That was what Janet Yellen said. And then, because of how much criticism she got from that statement, she kind of came out again and said, well, we're going to do whatever we can to protect all depositors. What does that mean? Nobody knows. That's why there's so much concern about the banking sector and investment institutions, because people are worried about the safety of their money, which is why you've been seeing a lot of money go into things like treasury bonds. You've been seeing people diversify their money into multiple different bank accounts. Now, the thing that I want you to remember here is that FDIC insurance protects you for your first $250,000 of your savings. We did a full deep dive of this in Market Briefs, which is why if you haven't joined Market Briefs yet, I highly recommend you do so, because it's a free newsletter where my team is breaking down what's happening in the financial news, to the stock market, to banking, to real estate, to the housing market, to the global economy. It's completely free, and you can read it in less than 5 minutes every morning. So if you haven't joined Market Briefs, I got the link for you down in the description below. So when you put your money into, say, a savings account, you have $250,000 worth of insurance per depositor, per bank. So if you have, let's just say, $1 million, and you take $250,000 and you put it in 4 different bank accounts, in 4 different savings accounts, all of your money is protected. But now what if you put your money into, say, in an investment account? Like you put your money into Charles Schwab brokered ETFs. Well, now it's a little bit different. Now, because your money's not in a savings account, you don't qualify for FDIC insurance. Now there's a separate type of insurance for the brokerage side, which is SIPC insurance. SIPC insurance protects your money in a brokerage account up to $500,000. Now there's different regulations here, because it's not just $500,000 blindly, because if, let's just say, hypothetically, you put your money into Charles Schwab's brokerage account to buy stocks, but all that money, the $500,000 is sitting in cash, they're not going to protect all $500,000. They'll only give you up to $250,000 worth of protection in cash. But if you have the $500,000 sitting in your Charles Schwab brokerage account, and all $500,000 is, say, invested into ETFs or stocks or whatever it might be, and then Charles Schwab, again, hypothetically, if they were to fail, then what does that mean? Well, now you would get the SIPC insurance to kick in, and they would give you the $500,000 worth of assets that you lost. So FDIC insurance is there to protect you against failures to banks, meaning like savings accounts types of things. SIPC insurance is there to protect you against investment brokerages where you're investing in stocks, and that has up to $500,000 worth of protection. So if you have under these limits, there's not much you really need to worry about besides just the inconvenience of, if my bank failed, getting that money back. The insurance is there to protect you, and you have these 2 insurances, which is backed by the full faith and credit of the United States government, which essentially means that the government has the ability to print this money with the help of the Federal Reserve Bank. So you have that insurance there. So if you're under the limit, the amount of worry, sure, you should still be worried. Of course, you always want to check your financial institutions. You always want to be checking the investment institutions. You always want to be doing your own research. You always want to do your own due diligence, which is why you should never blindly trust a random guy on YouTube, or really anybody. Always do your own research of where your money is. But if you have under the limit, you can at least sleep a little bit easier knowing that, well, that insurance is there. When you're above the limit, let's just say you have a few $1,000,000. Now you can diversify by putting your money into different accounts, different bank accounts, different brokerage accounts, and you can diversify your money that way. Now when you're talking about tens of millions of dollars, this is where things get a little bit more difficult. Because, yeah, sure, you can open up a few different brokerage accounts and a few different bank accounts. That's okay. But when you get up to, like, say, 10 or 20 accounts, now you can't really manage that many different accounts practically. And that's where you're seeing the bigger dollars now looking for alternatives. Some people are moving their money into things like physical gold. Some people are moving their money into things like Bitcoin. We've been seeing the price of both gold and Bitcoin rally so much because people are looking for alternative ways to keep their money. Now, of course, Bitcoin is much more volatile. It's speculative. And like I was saying, if you own cryptocurrency, like I own Bitcoin, I don't keep my cryptocurrency on an exchange. I keep my cryptocurrency on a hard wallet, a cold wallet for me. So it's a USB drive. but it's very speculative. I mean, it can go down to zero. So you have to understand that as well. And you want to make sure you can understand that risk versus something like gold. I wouldn't say it's it's definitely not as volatile as cryptocurrency, but it's still not stable like, say, keeping your cash in a bank. Obviously, gold goes up and down, but it is an alternative way to save money. Like for me, I consider my gold an alternative way to save money. I consider it hard savings. So I own some physical gold as well. And you've also been seeing people move their money to things like real estate, because again, it's another hard asset. So people are moving their money around because of all the craziness going on. And what I want you to understand is, one, how do you protect yourself? Two, how do you find opportunities? Because this craziness isn't going to stay around forever. It will be around in the short term. We will probably see more pain. We might see more bank failures, probably will see more bank failures. If interest rates continue to go higher, that will cause more pain in the economy. That would hurt banks more as well. And this is where now understanding that when people are panicking, it also creates opportunities. So being prepared to protect yourself, but then also being prepared to capitalize on opportunities, whether it be in potential banking stocks, if you can find opportunities there, whether it be in other asset classes, whether it be in stocks, whether it be in creating your own entity. There's going to be a lot of opportunities, and this is where now your job is, how do you find those opportunities and then actually be able to capitalize on them and hold on to them long enough to reap the rewards of investing your money while everybody else is panicking. So this is where the financial education is so important. We'll be keeping you posted on this channel, but also market briefs, which is why if you haven't joined yet, make sure you do so.